This is Chip Maxwell, and you're listening to the Retire Smart podcast with David Brooks. Does Medicare cover long-term care? If I'm not working during my retirement, do I still have income taxes? And how long has David been a financial planner? David Brooks has answers to these questions in today's Q&A episode. Into the Q&A we go. David, the first question is about taxes. I'm 65 and look forward to retiring in 2 years. If I'm not working anymore in retirement, my income taxes go away, right? Well, it's kind of a... Well, go ahead, David.
Well, under current law, most likely no.
Yeah.
Obviously, legislatures can change things. If you retire, and it sounds like you're going to retire at 67, for most people today, that's what's called full retirement age when it comes to Social Security. Now, if you only have Social Security income and no other income whatsoever, no interest income, dividends, no withdrawals from retirement accounts that have been tax deferred, you could be tax-free. However, the minute you have income from another source, not only do you pay tax on that income, you will then pay tax on $1 of your Social Security income. So in other words, you basically get double tax. And again, this is where people get confused. Well, I'm in a low tax bracket. Well, are you really? You see that $1,000 distribution you took out of your IRA to maybe give a gift to your grandchild actually has caused you to sometimes pay over 51% in taxes. We show this all the time.
Because you get taxed on the withdrawal, and then it triggers a tax on your Social Security?
Correct.
Yeah, there's that double whammy.
Yep.
Oh, my goodness.
And if you happen to already be on Medicare and you had too much income, you could create other taxes. So
that's
again,
the IRMA problem, isn't it?
Yeah. So no, unfortunately, you're probably not tax-free unless you've proactively set up a tax plan. Now, we potentially could get you to a 0% tax bracket. In fact, almost 4 out of 10 prospective clients that come meet with us, we can eventually get them to a 0% income tax bracket, but it does not happen overnight. It typically is going to take 4 to 6 years of a rigorous planning to show you how to efficiently move money from one tax bucket to the other. There's only 3 kinds of money, folks, when it comes to the IRS. There's taxable, tax deferred, and tax free. Which one do you want?
Well, and so behind all of that is what we call the Roth conversion, right?
Absolutely. That is one of many strategies.
I find myself in conversations with people who say, boy, one thing I'm looking forward to in retirement is I won't be working anymore and drawing a paycheck, so I won't have to worry about taxes anymore. Well, but wait a minute. You know, if all of your 401k or IRA funds were in one of those tax-deferred accounts, you were told, defer. Well, remember, when you start drawing from those accounts, that's going to be taxed unless you do something about it. That's where the Roth conversion, take your tax hit up front while it's lower, so when you actually do take out large sums of money, it'll be tax-free.
I was sitting down with one of our advisors with a new client in our Lincoln office here just a couple weeks ago, and they were very successful, owned a business, and saved diligently, did all the things, stepped into retirement, and then got smacked with all these extra tax liabilities and had no idea. Their advisor at the time didn't tell them, and their tax professional didn't tell them. And they were paying 4 of those IRMA or Medicare penalty lines each every year. They were paying almost $8,000 in penalty taxes, plus taxation on their Social Security, which they weren't aware of. And so they had a tax liability in 6 figures now. They're doing quite well, but it was about $50,000 more than they thought they were going to pay, and very easily could have been avoided with a little bit of proactive planning.
Keep that in mind, friends. Next question, David. Actually, we got 2 questions coming up about Medicare. Here's the first one. I'm 63, and I want to retire now, but I can't get on Medicare yet. What do I do about health insurance until I can get on Medicare?
So if you're 63, basically you're less than 2 years away from being able to roll onto Medicare. So your options are a few. You could try and self-insure. Certainly don't typically recommend that because you could leave yourself some pretty big exposure there. You can purchase.
So when you say self-insure, you just mean basically roll the dice and see if anything happens.
Right.
If it does, I have to pay for it. If not, whew, I made it through. But ooh, that is a risky game.
It's a very risky game, yeah. And we would certainly not recommend that. I'm just telling you what your options are.
Yeah.
You could, when you leave your employer, if you get to 63 and a half, you may be eligible to roll onto what's called COBRA, where you get to keep your employer benefit. Now, just so you know, you're going to pay the whole freight here, plus an administrative fee. So you're going to find out all the money your employer has been spending on your behalf on that healthcare plan. And
ballpark figure, isn't that about 20 grand these days?
Yeah, somewhere around there. Yeah, I was going to say somewhere between $1,300 and $1,700 to $1,800 a month. Typically is what that's going to cost you. So yeah, a little over 20,000 probably.
Yeah.
But it would only it'd be short lived, 18 months, so you can at least know what your cost. And you should also factor in what is the out of pocket exposure on top of that, so you know your max risk there, right?
Okay.
And you can make that decision. You could buy what's called a skinny plan. So you have to remember the mandate to purchase health insurance was repealed. Right. So you're no longer required to buy health insurance. So now they're eligible to sell you what's called skinny plans that don't necessarily cover everything as it once had to. And you can also buy what's called short-term health insurance. It's for 364 days or less. There are carriers out there that will sell it to you and basically renew it the next year. So you could buy that. It's a little bit more of catastrophic coverage, which used to be old-fashioned, what we call indemnity insurance, right? Indemnify you for an unforeseen risk. Or you could look at alternative ways to get coverage through how I have personally my health coverage through a religious sharing organization. So I am, as you mentioned earlier, in my late 50s, and my health, I don't use the health insurance that I provide for you guys. I give money, a couple $100 a month, to a Christian health sharing organization, and then I have a max out of pocket every year of about $12,000 if I were to need drastic health care, and it covers me just fine. So these are just a handful of the options. That is the M in the SMART plan, but you need to make sure you make a good decision before you walk away. And not only is it good to plan this and be prudent, what if your employer says you're walking away, right? We walk into recession and this person is told, hey, you're retiring this year whether you want to or not. You need to be proactive thinking about what you would do in that example.
Another Medicare question, David. Does Medicare cover long-term care? That's a no, isn't it?
That's a no. Basically, absolutely, it's probably not going to cover you. Medicaid could potentially cover you for long-term care, but Medicare, not really. There are a very few instances where it could, but no, Medicare is to care for you as your care for the elderly, right? And so it's to assist you in your medical expenses, and basically your hospitalization is covered through your payroll deductions you'll be paying your whole working life if you qualify, and then you're going to pay a premium for Medicare Part B, which you have to sign up for, and that's basically for everything outside the office, screenings, doctor visits, outpatient surgeries, et cetera, and that covers you in an 80-20 split. And the 20%, though, is uncapped. So you would be exposed to 20% of the expense, and it's uncapped. Now, you can purchase private insurance. That's called a supplemental policy, or you can go on what's called a Medicare Advantage plan, which usually are advertised as zero premium. But be careful, there's a lot of out-of-pocket expenses there. You just need to know this stuff and come to our ABCs of Medicare class if you don't understand. But long-term care coverage, no.
Well, the M in a SMART plan, medical and other health expenses, because I find myself in conversations with people who think, well, first of all, some poor souls think Medicare is free health care. It is not. There are costs, and mistakes in how you handle it can be very costly. And secondly, they think that long-term care, well, if I end up needing long-term care, it's part of Medicare. No, it is not, and you need to plan for it. It doesn't have to wipe you out, but you got to be proactive about it and have a plan. David, here's an interesting question. I'm going to say this is about your own history. The question is two-parter, actually. How long have you been a financial advisor? What's your history in the business? David, you're at about a quarter century now, aren't you, in this business?
Yeah, so I first got licensed as a financial advisor, and I was a broker back then, Series 7, in 1999, so over 26 years ago. And then hybrided through. So just so you know, my history in the business, I started an old wirehouse company. That's what we used to call them, wirehouse, called Payne Weber. Doesn't exist anymore. Was purchased by UBS, Union Bank of Switzerland. They then changed their name to just UBS. And I have served in multitudes of roles in my career. So I was a commodities trader. I was a broker that did, buy and sold stocks, et cetera. I did the commodities trader mainly on the 10-year pit out of Chicago. So we hedged mortgages early in my career. I was part of a team that hedged the mortgage industry, and GE Capital, Chase Manhattan. These were our clients. This is all based out of Orlando, Florida, office that I worked in at the time. Moved over to the coast in Florida and went into management training planning program and was a branch manager for the largest financial planning company out there, and decided I had enough with corporate, so to speak. And so 2010, I walked away from the corporate world and opened my own firm and built that firm up. And that firm was acquired back in 2017. And due to some health-related issues that we had inside the family, we were looking to relocate where there wasn't quite as much sunshine to deal with on a daily basis with my wife. And so we ended up relocating here to Nebraska. And I was actually recruited here. I did not move here to start Retire Smart originally, but sometimes God has other plans for you. It's amazing. And but we started Retire Smart almost 8 years ago. The firm I came here for to do tax planning just didn't work out. I'll just leave it at that. And I'll just say me and the principal at that firm had a disagreement on some things. And anyway, God put us in place here, and it's just been an amazing ride since. And 3 years in a row, soon to be 4 or 5, Inc. 5,000 fastest growing companies in America. We just keep scaling and growing this company. And we're blessed to help so many people. And now we have clients all over, including back in Florida, et cetera. So in 22 or 23 states, whatever it is now, and still growing.
Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week.